And so we say, working capital must always be positive. The suggestion here is that we must use some long-term finance to finance not only the non-current assets, but also the current assets. Non-current assets must of course be financed using long-term money, but there must be sufficient long-term finance to cover permanent current assets as well. Permanent current assets are basically represented by the minimum amount of accounts receivable and inventories. And only the fluctuating portion of current assets is then financed using short-term finance. This is often called a balancing approach to working capital. Of course, there may be situations where companies want to use an aggressive approach to asset financing. For example, the short-term debt or short-term finance, instead of just financing the fluctuating current assets, might be used to finance part of the permanent current assets as well. This will result in the current asset ratio becoming smaller but still positive, because part of the long-term debt and equity capital will still be used to finance part of the permanent current assets. Now, this is appropriate if the company is about to raise a large sum of money by a bond issue or by an issue of equity shares. And sometimes it can also be a short-term strategy to take benefit of the fact that short-term finance is very cheap and readily available. In the same way, an opposite approach may be taken when the company has just completed an issue of shares or bonds, or for any reason is flush with long-term money. Then it will use long-term money to finance the non-current assets, the permanent current assets, and even part of the fluctuating current assets. Such companies would not use their overdraft facilities very much. Such companies would not have so much need for the standby credit because they are flush with long-term capital. So for working capital management, a company can either use a balanced approach, an aggressive approach, or a conservative approach, depending upon the circumstances under which it is operating. So is positive working capital is represented by a current ratio that is greater than 1. Basically, it provides evidence that we have some long-term finance available to support investment in current assets. And the recommendation is that companies should operate with positive working capital because this will ensure good liquidity and business sustainability. Let's move on now to debt finance or debt management. There are two important criteria for debt management that are often considered. One is the attitude of the company towards borrowing. Companies where the total borrowing to total equity ratio is less than 100% are normally considered to be conservative. Companies that display total borrowings to total equity greater than 200% are considered to be aggressive. That's one ratio. Another very important ratio, and sometimes overlooked, is the interest cover. Interest cover basically measures how much operating profit or earnings before interest and tax the company can generate for every $1 of interest that it has to pay. And the rule is that for every $1 of interest that the company pays, they should be able to find at least $10 of operating profit, and hence interest cover, which is EBIT over net interest expense, should normally be more than 10 times. There are some countries where it is suggested that it should be 5 times or less. But if you think about it, any company that uses 1/5 of its operating profit to service interest alone is probably using half of its operating profit to pay interest plus principal back to banks, and that cannot be a clever thing. So a safe measure of interest cover is that it should always be maintained at above 10 times. Finally, we need to know if the company's financial performance is one that is satisfactory or adequate from the investor's point of view. Basic investors need two things. One, they need to know how much money the company makes, and secondly, how much of that money they use to pay dividends. So the first ratio measures profit after tax to total equity, how much money the company makes, and the second one is how much of those profits are used to pay out dividend. That's the payout rate. Listed companies, however, have another third indicator, and that is a reflection of market confidence in the company. This is measured using the PE multiple or the PE ratio. The PE ratio is simply the price per share divided by the earnings per share. Generally, a sustainable PE ratio that is high indicates that the company is well respected in the market and the market has confidence about its sustainability. And finally, just to end this session off, I will touch on financial distress ratios. Some time ago, Professor Altman came up with the Z-score. It is important for you to understand that the Z-score is not simply a bunch of discriminant ratios. It is also actually a checklist of 5 criteria, survival criteria, that distinguish between companies that will be surviving, that have sustainability, and those that might not. The first one is ability to generate sales. This is a ratio we have seen, which is revenue over total assets. For every $1 in assets, how much is the revenue that the business can generate? Secondly, ability of the business to extract profits from business, and that's operating profit over total assets. Of course, the special thing that the Z-score model does is that it provides weightage to these different ratios. For example, ability to generate sales has a weightage of 1, whereas operating profit to total asset has a weightage of 3.3. Then we have the ability to manage working capital well. We have seen just now that that's very important. And managing business reputation on the stock market, which is a kind of inverse gearing ratio, market capitalization over total assets. And finally, a company's sustainability also depends on a healthy reinvestment policy. So if all of these 5 key criteria are used, the business is sustainable. In the area of performance management, we have looked at profitability, liquidity, working capital management, debt management, and investor returns. Those are the key indicators of good financial performance.